Cyber insurance has become an important part of risk management for law firms. But one thing I've noticed over the years is that many small to mid-sized firms have coverage that isn't quite aligned with the risks they actually face. Most of the time, the firm does have cyber insurance. That's not the problem. The issue is usually the details of that insurance. There are a few coverage gaps that I tend to see repeatedly. One of the most common is inadequate limits. Cyber incidents can become expensive very quickly. A forensic investigation alone can sometimes run $15,000 to $50,000 or more, depending on the complexity of the incident. Then there may be legal costs, client notification requirements, credit monitoring services, which can run up to $30 per month per person for 12 to 24 months, and sometimes business interruption if systems are unavailable. When you add those pieces together, the total impact can grow quickly. If the coverage limit is too low, the policy may help, but it may not go as far as people assumed. Another area I often see overlooked is social engineering coverage. This involves situations where someone is tricked into sending funds or sensitive information because they believe a request is legitimate. It might look like an email from a client, a colleague, or a trusted partner involved in a transaction. Unfortunately, not every cyber policy automatically includes strong protection for those kinds of losses. Sometimes it requires a specific endorsement. Another gap I occasionally see is business interruption coverage. If a cyber incident shuts down a firm's systems for a period of time, the impact can go beyond the immediate technical issue. Cases may be delayed, staff may not be able to access files, statutes of limitation could potentially be missed. Normal operations can be disrupted. Business interruption coverage is designed to help address that type of situation, but not every policy includes it in a meaningful way. Then there are deductibles. Some cyber policies carry deductibles that are much higher than people realize. It's not uncommon for firms to focus on the coverage limit without paying as much attention to what they would need to absorb before the policy begins responding. And finally, there's the retroactive date. This is an important detail in many cyber policies. It helps determine how far back the coverage applies if a breach or incident actually began before it was discovered. If the retroactive date isn't fully understood, firms may have a different expectation about coverage than the policy actually provides. None of these gaps happen because firms are careless. Most of the time, it's simply because cyber insurance has evolved quickly and policies can be complex. That's why it's helpful to periodically review the details and make sure the coverage still reflects how the firm operates today. A short conversation can often clarify a lot. Want some help reviewing your policy? Give me a call and we can review everything I talked about in this video to make sure that your firm has coverage that's right for you. Thanks for listening, and remember, I'm Don I, your insurance guy.